All right, so good morning once again. And this morning we want to look at IAS 10. IAS 10. Now, IAS 10 is about events after reporting period. Events after reporting period. And it's a very simple standard. I think this is the most simplest of all the standards. So as we always do, the first thing is to try to understand what it is by defining it, because when we know the definition, we will know anytime we face it in the exam, we will know that, oh, okay, so this is what we are being asked to do. So what is IAS 10 event after reporting date? Now, yes, it's an event. So we say that these are events, and these events can be favorable or unfavorable. Unfavorable. And these events occur, they occur between the reporting date. So the reporting date. Okay, so let's make an assumption that our reporting date, let's say the accounting year per what we are operating with in this scenario is 1st January to 31st. So our reporting date will be 31st of December. And let's suppose it's what, 2023. All right, so any event that will happen between the 1st of December and the date of financial statements are authorized for issue. Are authorized for issue. Now, if you know how financial statement works, what happens is that you prepare the financial statement as at this date. And what will happen is that then the auditors will come in and audit you. All right. So when the auditors come in and audit you, they will now file a report to the shareholders. So there will be an AGM meeting, and once the AGM meeting happens, then they authorize the financial statement for issue, to be published for everybody to know, because that is the basis for which they are going to determine dividends and everything. So let's say that, and most of the time in the situation in Ghana here, what will happen is that according to our law, you have 30th of April to actually do your filings to GRA. So all your AGMs and things for the authorization of the account must happen within this period, unless you want to, of course, go for the extension and take it to June, because the extension doesn't take more than 60 days. So it can be ended at what, June. So depending on the nature of the situation. So per our assumption here, what we are going to use will be the April one. So let's say 30th of April, and that will be 2024. All right. So anything that happened in this period, within this period, is what we call what? Event after the reporting date. All right, so basically that is that. All you're supposed to know for the purposes of your exam and your understanding of the standard is that the standard broadly categorizes these events into two. And so we have the adjusting events. So we have here adjusting events. And we have the non-adjusting events. All right. So basically, why are we trying to categorize them? There are certain events that happen that will affect the figures in the financial statement of 2023. Even though the thing is happening, let's say, between 2023 December 31st and that of 30th April in this scenario, it will have to cause us to go and change certain figures in our financial statement of 2023. But there are also certain things that happen that one won't really necessitate a change in the figures, but it warrants a communication that has to be done so that everybody will know what is happening about the entity. But how will you know this event is adjusting? And how will you know that particular event too is non-adjusting? There is a clue, and that is what I want to help you discover. Because if this is to come into your exam, those are the things that they will ask you. Now, adjusting events, bear in mind, what it does is that it gives you new or additional evidence, new or additional evidence. All right. So that is it. It is granting you what? A new, or it is granting an additional what? Evidence. Evidence of what? Evidence of conditions of any situation, any conditions or situations that existed, or any situation or condition existing at the reporting date. At the reporting date. So ask yourself, the event that is happening after the reporting date and before the financial statements are authorized for it, is that event giving me a new evidence or additional evidence of something that existed at the reporting date already? That is what you're supposed to know. Then what about the non-adjusting? These ones to give new evidence. These two gives new evidence. They give evidence on conditions which did not exist at the reporting date. So it is giving you evidence of something that didn't exist at the reporting date, but actually what actually existed what after, all right, but arose after the reporting date. So that is a clear distinction between this. All right. So that is a very clear distinction. So what I'm going to do is now give you some examples under each so that you'll be able to, and these examples that are the examples that the examiner is going to use to test your understanding. So let me give you some examples in both situations so that you keep. All right. So the first one I want to talk about over here is the sale of inventory after the reporting date. We did this thing at IAS 2, sale of inventory after the reporting date. All right. So the sale of inventory after the reporting date. What is it giving us? Remember, it is giving us evidence of the net realizable value at reporting date. So, because remember, we talked about IAS2, and IAS2 actually told us that we should measure inventory at what? Lower of cost and what? Net realizable value. So that is the subsequent measurement. But you see, they may be holding the inventory in their books at a specific amount, which let's say is the cost. But right after the end of the reporting period, let's say what happened is that they have the cost as their closing amount. So cost of sales or cost of closing stock or whatever it is, the closing stock. All right. So you have closing stock, which is valued at 30,000. Believing that if they are going to sell, if they are going to have the opening stock of this closing stock inside their next year, it will be still what at this cost of 30,000. But you realize that right after the reporting day, somewhere 2024, they sold these things at 25,000, which means there is a problem. That means that they should have actually recognized this thing back in 2023 at the lower of this. So you can't keep this high figure and sell it at this 25,000. So anytime you are preparing a financial statement, you have to be careful so that if there is anything of such happening, you write off the impairment to cost of sales. Very, very important. Very, very important. So anytime there's a sale after the reporting date of inventory, then you have to look out for an adjusting event for this, to go and adjust your cost of sale by impairing the closing stock you have here. So that's very, very important. All right, the second example that I'm going to give you is a bankruptcy of a customer after the reporting date. Bankruptcy. After what? Reporting date. So like we said, this is a new information. This one is a new information. The bankruptcy of the customer too is a new information. But it is giving us an evidence of a condition about our inventory at the reporting date. The same thing, this one too is giving us an evidence about our condition of our what? Receivables at the reporting date. So that is where you realize that if that is the case, we need to come back and apply IFRS 9, impairment of receivables. So that is that. What happens is that there has to be an allowance against what? The allowance, what we used to call bad debt, or here we call it what? Impairment against the receivable at the reporting date. At the reporting date. And later on, you learn this thing under IFRS 9, impairment of what? IFRS 9, impairment of assets. All right, financial assets. All right, so basically, that is that. That is that. Again, the third example that I'm going to give you will be about fraud discovery and errors. Fraud discovery and errors. Bear in mind, these are not like IAS 8 where the financial statements have been already authorized for issue. But here, the financial statement is yet to be authorized for issue, meaning that you can make any adjustment necessary. So if there are fraud that has been that has been discovered, or errors that has been discovered, then it means that it shows that the financial statement you have done is incorrect. So you have to just go back, since you've discovered it before the release of the financial statement, you have to go back and correct it. So in this case, when there is a fraud or the error, it just shows that the financial statement at the reporting date is incorrect. So all you need to do is to go back and correct it. So correct it, that's all. This is not a prior adjustment. You've not published the financial statement yet, so can you just make the correction? All right, so that is that. The fourth example that I'm going to give you here will be about a settlement of a court case after the reporting date. Settlement of a court case. All right, after reporting date. So probably you were given the suit during the reporting period. It's just that the judge is going to adjust the thing. So probably you served the suit somewhere October or November, let's say November 2023. But you don't know your liability if you are going to lose the case. And so, I mean, somebody also say you don't know your income when you are going to win the case, but that type of income, the IAS 37 is called contingent asset. We don't record them, all right? So we disclose those ones. Now, but as for provision, you have to check if you have a present obligation, because if you're going to lose the case, then it means you have a present obligation. So in that case, you know already existing that you have a court case there. It's just that the settling hasn't been done and it is going to fall into somewhere, let's say February 2024. In that case, if your professional lawyer tells you that you are going to lose the case, then it means that once it is confirmed, once the entity has a confirmed obligation from a professional, it means they have to make what? An adjustment. So when they settle the case right after the reporting date, that settlement is an additional information telling you that what was brought to you back during the reporting period has been now adjusted. So what that settlement is going to do is to confirm your present obligation. So now, when it confirms the entity's obligation, then what you're going to do is that you have to now make what? A provision. All right, so that is that. All right, that is that. So please take note of that. And if there is any amount received or receivable as insurance claim, all right, where it's being negotiated, that one too, like I said, these are what we call contingent assets. All right. So I mean, you don't know whether you're going to win the case or not. So the money that you'll be receiving from insurance company will be based on whether you win the case or not. All right. So these are all adjusting events. So let me say that amount received or receivable as insurance claim which were being negotiated at reporting date. So this one is a little open. So as at the time that by the financial statement was being prepared, you were on course negotiating for an amount from the insurance company. And that is also an adjusting issue, because what is going to happen is that it is giving you an evidence of something, your negotiation that was in process at the reporting date. All right, so basically that is that. Now let's look at some of the examples over here. As for this place, the key thing is that it is after the reporting period. So these are the things. So example are when a major business combination is going to happen, or there is a disposal of a subsidiary at the reporting date. So one will be disposal of SAP of a subsidiary after, or disposal of a subsidiary or a major business combination. All right, all happening after the reporting date. So if it is after the reporting date, then you have to make sure we will talk about the accounting treatment. So you adjust for adjusting events and you disclose for non-adjusting event. All right, so that is that. So that is one, reporting date. Then two, we have something like announcing a plan after the reporting date to discontinue. So the announcement, look at this very, very carefully. You are announcing a plan, all right, after the reporting date. What if the person announced during the reporting date that he would discontinue the thing after the reporting date? If you announce during the reporting date, then it means you have a present obligation to redundancy. And that means that that one will become what? An adjusting event. So please be careful. This one is what? After the reporting date to discontinue. But if it was during the reporting date, then it means that that one is under provisions. So you have to make your provision for your liabilities, because there's a present obligation. You are going to discontinue, you may be paying people redundancy. So please check the timing of the announcement. It's very, very important. All right, that is it. Okay. Third, what I'll give you is the major purchase or disposal of asset after the reporting date. Major purchase or disposal of asset after what? Reporting date. So here too, the key is that this thing is happening after the reporting date. So take note of that. All right. Again, let's say you have some distraction of your assets. So they got bent or something. So distraction of assets. The key is maybe by fire after reporting date. So if it is after the reporting date, then that one too is a non-adjusting event. So please take note of that. All right. So like I said, if you are going to also, if you see, let me add this, if you see fall in value of shares, fall in value of shares, so fall in share prices after reporting date, that one too. So the key is what? After reporting date. Of course, one will say, but say, these ones do also occur after the reporting date. Yes, it did. But what evidence? What is it giving you? So what evidence is it giving you? The evidence that is giving you are these conditions, disposal of the subsidiary existing at the reporting date? No. It is just a new thing they want to do. It's just that they've not authorized last year's financial statement for issue yet. So that it won't affect it, the 2023, to affect only what? Our 2024. But you have to communicate to the inside the 2023 account that these things happen right after the reporting date, 2023. So please take note of that. All right. So that is that. Then another one you can have is a court case commencing after reporting date. So it means that the person brought you the suit after, so it won't have anything to do with your last year. All right. So please, those are that. Okay. So let me also make this one, which is very, very important to me because we tend to miss on these ones. Equity dividends. Declared or proposed after the reporting date. This thing happens in real life a lot, and it's a non-adjusting event. You don't have to change any figure in your financial statement because you see, what happens is that most of the time, after the financial statement are authorized for issue, that is when the directors and the shareholders now they sit to do dividend declaration. And when it happens, so I'm going to single that one out again because before I even go there, let me say this. Let me give you the accounting treatment for this. So the accounting treatment for adjusting events is that you adjust. So adjust them. So adjust the financial statement. Then for non-adjusting events, all you have to do is that you disclose it. So disclose it in the notes. So these ones are disclosed. So what are you disclosing? The type of event. All right. And its estimated financial impact. All right. All right, so that is what you're going to do. Okay, so take this in mind. Now I'm going to come back to this proposed dividend concept on the equity shareholder. So let's look at that. Now, first of all, let me start with your going concern principle. What does the going concern principle say? The going concern principle is that the entity must assess, because first of all, the financial statement is prepared on what? going concern basis. And IAS 1 says that it must be stated emphatically that they are doing that. So you have to state it. What is going concern? That the company will operate for a foreseeable future and management have no intention of what? Seizing it. Now, the management must decide, are they liquidating? Are they ceasing operating or their operations? If they are, then fine. It means they have to do a breakup basis. All right, they have to do a breakup basis of financial statement. So what happens is after the reporting date, and there are events that are indicating that the going concern assumption is inappropriate, then management might decide to liquidate or cease trading. Because if you're going concern, there is a going concern issue, then it means you have to start stopping your financial statement preparation. IAS 1, remember, introduces us to MEG. You remember, if you are doing audit, it's called material uncertainty regarding what? Going concern. All right. So if events have arisen since the reporting period, then you have to issue a MEG so that so this is it. Okay, we have disclosed that there is a financial statement is rightly prepared, but there's a going concern issue. IAS 1, issue a MEG. That's it. All right, because there is going concern problem after the reporting date, which is like 2024. Are you getting it? Yeah. So if you prepare your financial, probably as at the time you are preparing the financial statement, there is no going concern threat. But by the time you are about to issue the financial statement, you see something happens to the entity. Like we said, your machines are bent and all those things. Then it means that before you release the financial statement, give us a note on the material uncertainty regarding what? Going concern. All right. And the entity should prepare financial statement if there is no going concern. That one, the entity should prepare the financial statement using what? A breakup basis. Now, to end this class, let me talk about the proposed dividend. The proposed dividend. Now, the proposed dividend, if the dividend proposed, all right, to equity shareholders or what we call ordinary shareholders, all right, but you have proposed it, but not approved. You have not approved it. It's not approved and paid. So even if you approve it and you've not paid, after the reporting date, should not be included in liabilities, as if, oh, we want to propose a liability. You have proposed it, you have not paid it, so it's a liability. So far as it's about equity shareholders, if you've not proposed, approved, and paid it, all right, after the reporting date, then it should not be included in liabilities as a liability to be paid at the reporting date. People do this a lot in practice. The IAS 10 is wrong. Why? Because these equity dividend are accounted for on cash basis. All right? Equity dividend are accounted for on cash basis. Please bear in mind, take note of that. All right, so that is that. So just be careful. So they must be disclosed as per what? IAS 1. All right? As per IAS 1 discussion that we have. All right, so ladies and gentlemen, this is all you need to know about your IAS 10. Very, very simple standard. What I can do now is to pick some questions and let us discuss them. All right, so let's solve these questions. So we look at these simple questions that have come for us to discuss. It says that This is November 2016. It said that Swami Limited is a listed telecommunication company which prepares financial statement for the year ended 31st October 2015 in accordance with IFRS 10. But the authorization for issue is what? 15th January 2016. So it's like from October to October, you have November, December, then middle of January. So it's like 2.5 months. All right, and these are the events that have happened in between. Says that Swami holds an investment in shares in a listed company, Asafo Limited, in Asafo Limited during November 2015. As November 2015 is after the reporting date, all right, there was a material fall in the value of Asafo shares. Analysts attribute this fall in value due to fraud dating back in 2014, and this 2014 that was discovered by Asafo in November 2015. Do you remember what we said about the fraud? That if there is fraud, then it means that the financial statement is incorrect, and that one is an adjusting event. But the fall in share prices, is happening after the reporting date. All right. So the question is the fall in share prices giving an evidence of something that existed at the reporting date? That's the first question you need to ask yourself. If it is, then it's adjusting. If it's not, then it's not. So how do we go about this? All that we have to say is that the fall in value of the shares is a non-adjusting. Although the fraud thing may kind of give an evidence of something that existed at the back at the reporting date, as far as the fall in value of the share prices are concerned, it's a non-adjusting event. So you disclose, and I mean, what do you disclose? The nature of the thing and the impact on the financial statement. That's all you say, and that's all. These are just bonus questions. All right, that's all. That's all. So this thing is a non-adjusting event. The fall in share prices. I think we gave it as part of the examples. Just that they kind of wanted to combine the two to trick you. But my friend, it's still a non-adjusting event. All right. So that is that. As part. If there is fraud that has been discovered after the reporting date, then that is it. That one is an adjusting. All right. But this one is the fall in value of the shares. They are just trying to tie it up, all right, to the fraud, but it's still a non-adjusting. All right. The second one says that in December 2015, which is also an event after the reporting date, the directors of Swami publicly announced a plan to reduce their workforce. When did they do that? They did that after the reporting date. So it's a clear or non-adjusting. So that is what you do. It's a very simple thing. You talk about this thing, you get your mark, you go. It says that Akapo obtained a license free of charge from the government to dig and operate a gold mine. Akapo spent 6 million digging it and preparing the mine for erection buildings on site. The mine commenced this date, and the license is prescribed for 20 years, and the site is supposed to be reclaimed, which means that you must remove everything and prepare the land as you came to meet it, right? And this one says that 31st August, Akapo Limited estimated the cost in the 19 years time for removal of the landscape to be 5 million, and its present value is 3 million. This thing is more of a PP. You remember, present value of future dismantling cost. Yeah, so that is what you do. So what do you do going forward is the unwinding that is in between. So this one says that on 31st, the massive earthquake in the area. Well, there was a massive earthquake in the area, and a couple mines shaft was badly damaged. So we ask ourselves, when is the ending of the reporting period? So this is 31st is the reporting period, and August, September, October, which means that the massive earthquake that is happening is right after the reporting period. The estimated it is estimated that the mine will close for 6 months and will cause all these things are happening after. So these ones call for what? A disclosure. All right. So that is that. Explain how you should treat the effect of the. Okay. So we weren't even asked to talk about the present value of the dismantling cost, but rather the effect of the earthquake. Well, it's a non-adjusting event, and you must what disclose. All right. So take note of that. So everything is set. I mean, that's all. These are things. If you have other questions, like I always advise you, You can look at them. All right, take your time, you look at them. If you want more of these, you can pick up the number. All right, and you can call. There is an online class, there's a face-to-face class. Wherever you are, we can serve you best. All right, so of course, when these things are done, there are always solutions there available for you to have it in your manual as well. So thank you very much for your time, and God bless you. We will meet again to talk about probably another disclosure standard, which will be like IAS 24. All right, God bless you. Have a great day.